Tesla's stock price up, and at the same time, the option price was down on Thursday after earnings on Wednesday this week. What is this about is our show for today. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. I wanted to thank our Patreon supporters as well as our visitors that are new to the show. So today's show focuses on a concept in options trading called implied volatility. So if you type that into Google, what you get back is implied volatility is the market's forecast of likely movement in a security's price. Implied volatility is often used to price options contracts. High implied volatility results in options with higher premiums and vice versa. In Wiki, implied volatility says, in financial mathematics, the implied volatility of an option contract is that value of the volatility of the underlying instrument, which, when input in an options trading model, will return a theoretical value equal to the current market price of said option. So I wanted to read this to you for you guys today because there are several of you that we've helped we actually have a tutoring class that's 1 hour long in options trading. And there are some folks that we've sort of been teaching, and there are other folks that have been learning from our videos. So we wanted to do a show today on implied volatility. For one good reason, we just saw a clinic on implied volatility from Tesla this week. What happened is that as you know, when the stock opened on Thursday after the Wednesday earnings announcement, it was at a high, if you will, at pre-market, and then it started falling and continued to fall all the way down 200 points. By the time we had gotten to Friday, it had gone from the 670s down to the high 1300s and then back into the 1450s, and it was moving around a great deal. So there was actually several articles in CNBC and the Wall Street Journal that indicated that the implied volatility expected there to be a 200-point move in Tesla's stock price. And so if you look at it, it actually went in line with what implied volatility suggested. Instead of it being a 200-point up, though, which we expected from Tesla heading into the S&P admission, it was 200 points down, which is like, what's going on here? So this is a show that I've been kind of wanting to avoid for two reasons. Number one, we're getting into an area that I can't claim I'm the world's expert on, but I understand how it works and how it influences things. I wanted to ask you, if you're serious about understanding what we're talking about, to stop for this video and go over to Yahoo, type in Tesla in Yahoo Finance. TSLA is the Tesla stock symbol, but if you type in TSLA options and then look at the option string, you'll notice there are actually three components to an option. That's the time value, how much time there is before it expires. Then there's the proximity to price. So the closer you are to the price of the stock currently, the higher the price is. And the third component is implied volatility. So if you look across the line, the last item they'll list there is what the implied volatility is. You got to multiply all three in order to get the price of the option. Usually that implied volatility number is so low that it's fairly not noticeable, except for now. So what kind of happens is that as you get right up to earnings, you have a very high implied volatility for any stock, like Amazon is announcing this week, Shopify is announcing this week. You'll see their implied volatility go way up just before they announce. And then after they announce, if the stock doesn't move dramatically, you get what you just got with Tesla. So if you're trading options, you can't have stocks go sideways. They have to go up or down for people to make money, obviously depending on if they have calls or puts related to that. So I bring this up to you because we had a situation this week where obviously the stock price fell dramatically on Thursday morning, and so fast that a lot of people that might have wanted to get out couldn't. And there was the hope that the stock might actually swing around and recover, which obviously it didn't. For the reasons we actually covered 2 videos ago, primarily the stock is ahead of its fundamentals, and without the boost of the S&P, that's where we're at with the stock price currently. I wanted to do this video because I went through a walkthrough process. I saw what was happening, sold out of my positions, did lose money, but it was able to get out. And after an hour or so, I ended up calling my trading buddies. I have some good friends in Detroit that we compare notes and trade together and learn together how the markets work, etc. And so our largest trader, he lost some serious bread there, and he was highly upset. And when I called him, he said to me, "Greg, this is clearly market manipulation. I can't believe they did this to us, etc." And I said to him, "Look, that kind of makes sense, but the problem is that there's something called implied volatility, or delta. So the problem is that every time we go into earnings, because we know there's going to be a big change based on how the market perceives what earnings look like, every stock, especially the major ones that trade a lot, like Tesla, will have big moves around earnings. And so that implied volatility is one of the components that's built in. So you'll notice that options that were fairly inexpensive or not as expensive, they're like 3 or 4 times their normal price for the amount of time and distance that it was from the stock. And the reason was implied volatility. And the problem is, after earnings, if you don't get the push in the direction you want from that implied volatility, you all of a sudden have the implied volatility go to 0 instead of whatever it was. Tesla was really high in the 1.5, 1.5, I believe. And so without that, you all of a sudden, and the stock price ballparking it around the same, all that happens is the value of the options falls dramatically right there. So in the case of Tesla, literally, you actually had situations where the stock price was actually rising and the option price was falling because you all of a sudden took away implied volatility or chopped it down to a lot lower number. And that implied volatility declining resulted in option prices that were falling. So it did really look manipulative, that what was going on by the market makers, but it's actually built into the model of how options are priced. So I think it's unfortunate. I always hate when good friends lose money, etc. I definitely lost money on the situation as well. I believe that the trading of Tesla pre-earnings into what happened on Thursday and Friday is one of the most difficult sort of trading environments I've seen. The reason is you kind of want to use puts or calls or puts to protect your call position. But the problem that came up was the cost of the puts were in the 10,000 plus zone at any distance would even be more than that. And so when you get up into puts that are that pricey, the number of people that can afford to play in that game is really small. So I just think it's, extremely unfortunate and it's sad, but sometimes you kind of learn how things work better based on a slight beatdown that you can take in certain circumstances. As I thought it through, I wondered, well, how could one have traded that better? And I really think the answer is when you're seeing implied volatilities as high as what Tesla was, it was implying the stock was going to run nicely. But you also have to be mindful of that, there are dangers associated. This is an important conversation to have right now because once Tesla is announced into the S&P, I believe there are going to be multiple days of the stock price starting to power up and dramatically. And so we're kind of waiting for those days right now. Hopefully they happen quickly so that we can enjoy those benefits. But being prudent and mindful of how things can work is a good idea. The only solution I could come up with this past Thursday was to say, hey, sit in your options until end of the day on Wednesday, sell out, and then either go into after hours to pick up some shares if you have that trading ability, or simply wait until the next day, see which way things are going, and now you know what to do trade-wise. Yes, you're going to miss 5-7% if it's a fast-moving stock, but you could also miss a major league beatdown like the one that just happened because of Tesla. So I felt really bad because when I called up our lead trader and we were talking, he was extremely upset, and rightly so, because there's a lot of money on the table that went away. And as he reviewed manipulation clearly that cost all that money, I just pointed out that part of the experience of trading is things can happen, and the more experience you get, the more you're able to plan for those things. But in this case, it was just a brutal situation, because if you tried to hedge your positions using puts and not time or some other method, it was horrible, because the prices of everything were so high that it was prohibitive to actually buy. So for those of you who went out multiple weeks as a way to hedge rather than using puts to do so, congratulations. I also wanted to mention that getting a trade alert and selling as the trade alert says to do so is another way to go. A good way to go in this case actually would have been a stop loss, because you'd have been able to take somewhat of a loss but be taken out rather than waiting for it to keep going. And this brings up a problem I've had in trading recently with Tesla and some other stocks, and that is that there are some of them that have this habit of having a drop of 30 to 40 points, and then they start rising again. And this really highlights why the bots sell the entire portfolio for the hedge funds. And it's also a good time for you to consider the same thing as well, because you could run into a problem. But the challenge with Tesla and some other stocks I've been watching is that, yes, you will miss a recovery that might occur, but the problem is if you ride that, if it's a put going down or if it's a call going up, all the way, hoping that it'll turn around to the other route, that might occur, but if it doesn't, you lose all that cash. And so I clearly think that's kind of a subtext to what happened this past week as well. So the other final thing I wanted to review here is that, I don't trade Amazon I've traded Amazon a little bit, have made just a little money, I've lost more money than I've made there, and I tend to avoid them because they're so big, and that stock price can move so quickly to either give you money or just take everything away quickly. Their implied volatility actually is very high because the stock price is very high already, and it's extremely volatile, and they're announcing earnings this week. So that's basically for grown men only, in that it's a great stock to trade, but you have to have very large dollars to stomach what Amazon can do to you in one day, good or bad. Getting back to Tesla here, the big expectation is what happens S&P inbound. And obviously we're hoping for a nice push of the stock price to go with this. The thing is that being locked in with your stop losses or with your put strategy or with your time-based strategy, be it leaps or other things or multiple months out, you really have to be mindful of what you're doing, because the potential to get crushed is actually very, very high. So I'm actually looking forward to comments from you. We typically try to avoid such an intense look at how options work, because we kind of split maybe 60-40 people who are focused on exclusively stock, and then looking over at people who are doing options. It's a smaller group, but it's prudent to look at this. The one other suggestion I would make to encourage you to research is a concept or an options trading strategy called call spreads or put spreads. Requires a lot less capital to do. You make less money in the process, but you actually cut your risk nicely, because you're able to buy options that are close to in the money when they might actually be extremely expensive to do so. Again, chops down your potential return, but it gives you flexibility that allows you to manage the environment better. So I want to thank you for taking time out to discuss this. We're looking forward to seeing, what's your reaction to our discussion of implied volatility and techniques on how to manage your portfolio when it comes to Tesla and stocks like it that are volatile and where you can make a lot or lose a lot very quickly. The reminder today is 25 leg lifts if you can. Also, the 5-2 or some other diet that allows you to manage diet better. Also wanted to encourage you to consider a 30 SPF or better if you're in the sun. And finally, once or twice a week, weightlifting to improve bone density is a suggestion. Salam alaikum. Tschüss, German. Au revoir, French. Lehit Rod, Hebrew. Hoda, Hafez. Farsi, Zdravstvuyte. Hello in Russian. Ni hao ma. Hello in Chinese. And in Jamaica, we say, enough respect, walk good man. Want to thank you for taking time out to join us today. We look forward to your comments. Please take time to like and subscribe. And remember, hit us up regarding SpaceX if there's interest. Have a great day, and bye for now.